If a book can change the way you see the world, this is where you'll find it. Welcome back to my channel. Let's explore together the books that truly shape our destinies. Today, we're diving into the 5 Rules for Successful Stock Investing by Pat Dorsey. And if you've always felt that the stock market is a bottomless pit where the money you make by luck eventually gets wiped out by your own strength, then this book might completely change the way you think about investing. Pat Dorsey isn't just another academic who talks theories for a living. He was the head of equity research at Morningstar, one of the most respected investment research firms in the world. His daily job was to analyze thousands of financial statements and figure out why stocks rise and fall. Morningstar's reports guide millions of investors globally, and Dorsey condensed decades of real-world experience into this one book. What's more, his thinking is shaped by 2 giants, Warren Buffett's moat theory and Charlie Munger's checklist mindset. They sound complicated, but Dorsey breaks them down into simple tools that anyone can use, which is why many people call this book the practical upgrade to Buffett and Munger's ideas. Now, why does this book hook ordinary people? Because most investment books are full of formulas and jargon, and you still don't know how to pick a stock after reading them. But this book makes investing feel almost like learning to cook. First, it teaches you to understand the ingredients, the company's financials. Then it teaches you how to judge the heat, the company's competitive strength. Finally, it teaches you when to turn off the stove, valuation, and the right time to sell. Take the 5 golden rules he introduces. The very first rule is preparation. In simple terms, don't buy a stock just because someone told you it's good. Look at the company's annual report. See how it makes money, how much debt it carries, and whether its profits are real cash. It's like buying a house. You check the title and the layout yourself, instead of believing everything the agent says. Most people lose money because they're lazy. But in this book, every chapter ends with a checklist, and even beginners can avoid 80% of the traps. He also emphasizes economic moats again and again. A moat is simply a company's ability to keep earning money for a long time. Think about Walmart. Why can it sell cheaper than competitors and still make money? Because its cost control is a moat that others can't match. Even if you don't understand accounting, the book teaches you to judge moats through simple questions. Is the product hard to replace? Can the company charge more than others? Are its costs lower than its peers? This is far more reliable than staring at candlestick charts and guessing the next move. For most people, the greatest value of this book isn't telling you which stock to buy tomorrow. It's helping you build a mindset that won't get harvested by the market. You'll realize that your biggest losses, chasing trends, panicking during dips, trading too often, all come from forgetting that buying a stock means buying a business. And this book forces you to ask a key question. If I were to buy the entire company, how much would I pay? Once you start thinking this way, short-term price swings stop controlling your emotions. Dorsey also understands what scares ordinary investors: accounting fraud, hidden risks, and complicated valuation methods. That's why he devoted an entire chapter to warning signs of fraud. For example, when cash flow doesn't match reported profits or when accounts receivable suddenly spike. These signals are like the company shouting for help, and recognizing them helps you avoid disaster. As for valuation, he doesn't make you solve formulas. He simply teaches you to use a margin of safety. If you believe a stock is worth $10, wait until it falls to 8 before buying. Even if your estimate is wrong, your downside is limited. What moved me most is that this book doesn't sell fantasies about getting rich overnight. It tells you that investing is like growing a fruit tree. Choose the right seed, give it time, and the harvest will come. If you're tired of chasing rallies and fearing every dip, and you want to grow your wealth slowly and steadily, then this book might be the moment. You finally realize that the key to making money isn't predicting the next price move. It's understanding the business. It's simple, almost too simple, which is why most people ignore it. But whether you're a beginner or someone who's lost money and wants a comeback, this book is worth studying carefully. It won't turn you into a market wizard, but it will help you become a clear-headed investor who knows what you're buying, why you're buying it, and when it's time to sell. Because in the end, investing isn't about beating the market. It's about beating your own impulses, fears, and this book gives you the protection your rational mind needs. So now, let's open the book and start breaking down the real lessons inside. Investing is not a game of guessing which way the stock price will move. It is the practice of using a rational framework to filter out companies that can keep making money over time. Pat Dorsey's 5 rules are essentially a way of turning Buffett's economic moat and Graham's margin of safety into something ordinary investors can actually use. They help you upgrade from following market rumors to holding stocks with clear reasoning. The first rule is this: do your homework and don't be a mindless follower. The core idea is simple. Before you buy a stock, you must investigate it as thoroughly as you would when buying a home. You wouldn't spend hundreds of thousands just because an agent says, this house will go up. So don't buy a stock just because an expert recommended it or because it hit the daily limit up. Your first step is understanding the fundamentals. Read the financial statements and focus on the big 3. The balance sheet shows the company's financial foundation. The income statement shows its ability to make money. The cash flow statement shows the real cash. For example, if a company reports profit growth of 30%, but its operating cash flow is declining, that may be a sign of paper profits. Next, study the industry and the company's position within it. If a semiconductor company holds less than 5% market share but claims to be a technological leader, you should be cautious. Then examine management. Are executive salaries tied to performance? Are the executives selling shares frequently? If the CEO makes $20 million a year while profits have fallen for 3 straight years, that may be a sign of extracting value from shareholders. Then verify the business logic. This can start with experiencing the product yourself. If you are buying a consumer stock, use its products. Maybe a tea drink brand you like has gone public. You notice the taste hasn't changed, but the financial report shows raw material costs jumped 30%. That could mean profits are getting squeezed. You should also compare competitors. Suppose an EV company reports 50% growth, but the industry average is 80%. That likely means it is losing market share. 2 metrics matter a lot here. Free cash flow, it is more meaningful than net profit. If a company makes $10 billion in net profit but spends $8 billion in capital expenditures, its true free cash flow is only $2 billion. That means expansion is too costly. The second is ROE, return on equity, how much profit a company makes for each unit of shareholder capital. Companies with ROE consistently above 15% often have moats. Matai, for example, has maintained ROE above 30% for years. And always beware of stories. A tech company may claim it will revolutionize an industry, but if R&D spending is below 5% and its patent count is far behind competitors, is likely just hype. In 2021, a certain online education company surged after going public. Its financials showed that 70% of revenue came from prepaid tuition, while cash flow was negative. When policy shifted, the stock collapsed 90%, and retail investors were wiped out. The second rule is finding an economic moat, the company's shield against competition. A moat is simply a company's ability to defend its profits over time. Without a moat, a company is like a castle with no walls. Competitors will steal its profits sooner or later. There are 4 major types of moats. The first is brand strength. Matai can raise prices year after year because consumers pay for its brand premium. Other liquor brands often can only compete by lowering prices. Here you look at gross margins. High-end liquor brands typically have margins above 70%, while normal brands sit around 30 to 40. The second is cost advantage. Walmart uses global sourcing and optimized logistics to keep costs 15% lower than competitors. Even at low prices, it still makes money. Small supermarkets can't copy this scale effect. You can look at whether unit costs keep falling. For example, a manufacturing company that lowers its cost by 5% every year is likely strengthening its moat. The third is technological barriers. Pfizer's patented drugs enjoy gross margins above 80% during the patent period. But once the patent expires and generics enter the market, profits fall sharply. Here you look at R&D spending and patent leadership. Fourth is network effects. A platform becomes stronger as user numbers grow. If adding 100 million users only increases costs by 5%, that's a powerful moat, but beware of two things. High market share does not automatically mean a moat. Kodak once controlled 90% of the film market, but collapsed when digital photography arrived. And always watch for erosion signals, falling margins, shrinking market share, or declining R&D spending. A smartphone brand that let innovation stagnate saw its gross margin fall from 40% to 23%. The third rule is margin of safety, giving yourself room to be wrong. Even the best company becomes a bad investment if you overpay. A margin of safety is essentially buying at a discount, so you can survive valuation mistakes or a market crash. Mathematically, it is intrinsic value minus market price. In practice, you usually want a discount of 30 to 50%. There are three ways to estimate intrinsic value. Discounted cash flow, forecasting free cash flow for the next 10 years and discounting it back. For example, if a company produces $10 billion in free cash flow annually with an 8% discount rate, its 10-year present value is around $67 billion. Second, PE comparison. If the industry leader trades at 20 times earnings while a similar company trades at 15 times. Third, PB, price to book, often used for banks. A bank trading below 0.8 book value is often undervalued. Different business types require different safety margins. Companies with wide moats like Mutai or Apple can accept a discount of 20 to 30%. Ordinary companies like industrial manufacturers need 40 to 50%. High-risk startups need more than 50%. During the 2008 crisis, U.S. stocks collapsed. Buffett bought BYD at 8 Hong Kong dollars per share, when the PP was only about 10, far below industry levels. The stock later rose to $80. The margin of safety protected him even in extreme conditions. But never use a rear-view mirror valuation. A company might have averaged a pay of 30 over the past 5 years and now trades at 25. That alone does not make it cheap. You must look at future growth. Also, beware of earnings manipulation. A company may use accounting tricks to inflate net profit, making the PE look low, while cash flow is actually negative. In that case, compare free cash flow to net profit. The fourth rule is long-term holding, letting compounding work its magic. Frequent trading means paying fees and taxes. Long-term holding lets the company's growth show up in your returns. It offers three benefits. First, lower costs. If you trade once a year, your annual cost may be 2%. But if you hold for 10 years and only trade once, total cost might be just 0.22%. Second, you avoid emotional decisions. Watching prices every day tempts you to chase highs and panic sell lows. During the 2020 pandemic crash, many investors sold at the bottom and missed the 50% rebound. Third, you enjoy the company's growth. Good companies grow profits and dividends over time. This gives you the Davis double, where earnings rise and valuation rises too. Coca-Cola's net profit grew tenfold over the past 30 years, and the stock rose 20-fold. The fifth rule is knowing when to sell. Don't be the ostrich that hides its head. Investing is dynamic, not buy and forget. When the fundamentals or valuation shift, you must reassess. There are 4 sell signals. First, the moat is eroding. If a restaurant chain expands too fast and unit profits drop, while competitors launch similar products and take market share, it's time to sell. Compare the past 3 years of margins, market share, and R&D spending. If they're getting worse, be careful. Second, valuation is overstretched. If a AV company trades at 200 times earnings while the industry trades at 50 times, and future earnings growth is only 30%, the valuation is already priced in. Use DCF. If the market price exceeds intrinsic value by more than 50%, exit. Third, you find a better opportunity. If company A offers an expected return of 10%, but company B has a wider moat, lower valuation, and an expected return of 15%, you should sell A and buy B. Compare row, free cash flow, and competitive position. Fourth, your personal needs change. If you need cash to buy a house, you should sell even if the stock is still undervalued. Investing must serve your life, not the other way around. Taken together, these 5 rules form a complete chain. Doing your homework and finding moats help you identify great companies. The margin of safety ensures you buy them cheap. Long-term holding lets compounding work. Knowing when to sell prevents major drawdowns. In the next section, we'll break down the 7 traps investors fall into and how these 5 rules help you avoid them. Most investors don't lose money because they're not smart enough. They lose money because they fall into human traps. The 7 mistakes Pat Dorsey outlines in his book all point to the same thing. Actions that violate the basic principles of value investing. Either you ignore the true nature of a business, or you let emotions take control. And if you can simply avoid these traps, you're already ahead of 80% of retail investors. The first trap is always trying to swing for a home run, always wanting to find the next Microsoft. The problem with that mindset is simple. It's driven by the fantasy of getting rich overnight. People focus on tiny companies or hot stocks and dream about doubling their money. And most of the time they end up stepping on a landmine instead. Since 1927, small cap growth stocks have returned about 9.3% a year, which is actually lower than the S&P 500's 10.7%. And the real danger is that small companies fail at an extremely high rate. From 1997 to 2002, roughly 8% of NASDAQ-listed companies were delisted every single year, and shareholders of more than 2,200 companies lost everything. Here's the irony. Even if you really did find the next Microsoft, you need to hold it for more than a decade to truly benefit, and most people simply can't hold that long. Dorsey's advice is to prioritize companies that consistently make money, not companies that might make you rich. Investing is about stacking small wins. If you make 15% a year, your money grows 16-fold in 20 years. The second trap is believing this time is different. But history always repeats itself. The core mistake is assuming the current market cycle is somehow special. Claims like semiconductors won't have cycles anymore, or the internet bubble won't burst, and every time investors end up buying at the top. History shows markets follow the same rules. Capital always flows to high-profit industries, and eventually forces returns back to the mean. In 2000, people insisted semiconductors were no longer cyclical. The sector crashed soon after. In 2001, energy stocks were hyped to grow 20% a year. Then prices collapsed due to oversupply. And human nature doesn't change either. When we're greedy, we ignore risks. When we're scared, we ignore opportunities. That script has played out on Wall Street for 100 years. Dorsey's simple rule is, whenever you hear "this time is different," stop and dig through history. Has a similar situation happened before? How did it end? Remember, there is nothing new in the stock market, only old stories and new packaging. The third trap is falling in love with the stocks you own, assuming that because you like a company's product, the stock must be a good investment. But good products don't automatically make a good business. Palm's handheld devices were wildly popular at one point, but the industry was brutally competitive. Margins were thin, and the company eventually collapsed. Emotional attachment blinds you. Many investors buy a stock and then focus only on positive news while ignoring red flags. Like corrupt management or shrinking market share, they become ostriches, sticking their heads in the sand. The right approach is to ask yourself, if I were buying the entire company, how much would I realistically pay? That's valuation. Can this business hold off its competitors? That's the moat. And instead of trusting your feelings, look at hard metrics like net profit margin and free cash flow. The fourth trap is panicking during market crashes. When others are fearful, you become even more fearful. Many people dump their shares during big sell-offs, only to sell at the bottom and miss the rebound. But panic often creates the best opportunities. The book mentions that in 1979, Businessweek ran a cover declaring the death of equities, and what followed was an 18-year bull market. During the 2008 crisis, those who sold in fear missed the next decade of growth. Dorsey's research shows that the most unpopular funds, the ones investors pulled money out of, ended up outperforming the hottest funds over the next 3 years. And when COVID sent markets down 30% in 2020, many investors panicked and sold, even though the fundamentals of good companies hadn't changed, and the market rebounded more than 50% within months. The right move during a crash is to ask, does the company still have a moat? Are earnings still growing? If yes, don't rush to sell. And create a crisis playbook ahead of time. Maybe add at minus 20%. Add more at minus 30% to avoid emotional decisions. The fifth trap is trying to time the market, trying to sell at the top and buy at the bottom. But timing the market is a fool's game. Nobody can accurately predict short-term price movements. Academic studies show that from 1926 to 1999, only 1/3 of timing strategies beat simple buy and hold. And even those winners couldn't do it consistently. On top of that, trading costs quietly eat up your gains. Dorsey calculated that if you rotate your portfolio every 6 months, after 30 years, your returns will be 60% lower than if you just held your positions, all because of taxes and commissions. The solution is to accept that timing the market is impossible. Use dollar cost averaging to smooth your entry price, or trim when valuations are extremely high and add when they're extremely low. Retail investors must remember this. When you trade too often, your biggest opponents aren't other traders. They're transaction fees and the tax office. Long-term holding is your only real advantage. The sixth trap is ignoring intrinsic value, treating stocks like a game of musical chairs. Many people buy and sell shares based purely on price movements, never asking what the business is actually worth. They assume someone even more foolish will buy from them later. But prices always return to value. During the dot-com bubble, many stocks traded at more than 100 times earnings and eventually fell 90%. Meanwhile, consumer companies with lower PEs fell less and recovered faster. Relying on a greater fool is not a strategy. How do you know you won't be the last fool holding the bag? Dorsey's solution is simple. Before you buy, calculate intrinsic value, use historical P comparisons or discounted cash flow model. Remember, buying a stock means buying ownership in a business, not a casino chip. Unless you're literally gambling, then that's a different conversation. The seventh trap is believing earnings tell the whole story when earnings can be manipulated. But cash flow can't. Many investors only look at net profit and ignore the cash flow statement, which makes them easy to fool. Net profit is highly adjustable. Companies can inflate earnings by recognizing revenue early or reducing depreciation. But the cash flow statement is much harder to fake. Real businesses generate operating cash flow. Dorsey emphasizes that if operating cash flow is flat or declining while reported earnings are rising, that's a serious warning sign. It could mean receivables aren't being collected or inventory is piling up. The right move is to compare net income with operating cash flow. In a healthy business, the two should grow together. And pay close attention to free cash flow, operating cash flow minus capital expenditures, because that's the money the company can truly return to shareholders. All seven traps ultimately point to the same fundamental problem: drifting away from business reality and letting price swings or emotions take the wheel. Chasing momentum in short-term trading ignore the core principle of owning quality businesses for the long run. Believing this time is different or panic selling ignores basic market laws. Falling in love with stocks or trusting earnings without cash flow means forgetting that buying a stock is buying a company's ability to make money. Avoiding these traps is just a defense. To truly play offense, you need the tools to identify great businesses. And next, we'll move into the essential tools: how to use financial statements, competitive moats, and key metrics to find companies that can survive and thrive through economic cycles. Choosing a company is a lot like choosing a watch. No matter how fancy it looks on the outside, what really matters is whether it keeps accurate time and whether it lasts. The real skill in identifying a great business is learning to see through all the flashy buzzwords and finding the core. The ability to earn money consistently in a way competitors cannot easily take away. The tools Pat Dorsey provides are essentially a full medical checkup for a business. First, you examine its competitive strength, which is its moat. Then you check its financial health through its statements. And finally, you look for signs of fraud, which are your early warning signals. The first tool is the economic moat, the company's bulletproof vest. A moat is the unique advantage that protects a company from competitors, allowing it to earn more than its peers over long periods of time. A business without a moat is like a warehouse without a lock. Eventually, the profits get stolen by competition. So how can ordinary investors identify a moat? Step one is to look at a company's historical profitability and verify it through financial metrics. The book makes it clear that the strongest evidence of a moat is consistent excess returns. There are 4 key indicators. The first is free cash flow, operating cash flow minus capital expenditures, which tells you how much discretionary cash the business actually produces each year. Great companies typically have free cash flow margins of 5% or more, and firms like Pfizer consistently exceed 8%. The second indicator is net profit margin. Out of every $100 of revenue, how much ends up as profit? Companies that maintain margins of 15% or higher over long periods, like Mutai, very likely have a moat. The third is ROE, or return on equity, which tells you how much profit the company earns for every $100 invested by shareholders. If it stays above 15% for 5 consecutive years, like Apple, the company is highly efficient at generating profits. The fourth is ROA, return on assets. It measures how much profit is produced by every $100 assets. Stable levels above 7%, as seen in Walmart, show strong asset efficiency. Step 2 is to identify where the moat comes from. There are 4 possible sources. The first is product differentiation. The product is either truly better, like Pfizer's patented drugs, or customers simply believe it is better. Like Tiffany's brand premium, the test is simple. Can the company charge more than its competitors, and do customers willingly pay for it? The second source is cost advantage. The company can sell the same product at a lower price and still make a profit. Dell, for example, uses a direct-to-consumer model that cuts out middlemen. Its inventory turns over 15 times faster than HP's, which naturally lowers costs. The third source is high switching costs. When customers need to spend a lot of money or time to switch providers, they tend to stay. If a company is already using Oracle's database system, switching would require retraining employees, which is expensive and disruptive. The fourth source is network effects. The more people use the product, the more valuable it becomes. On eBay, more buyers attract more sellers, and more sellers attract more buyers. Eventually, the platform becomes impossible to leave. The second major tool is reading financial statements, the company's medical report. Financial statements are the language of a business. The balance sheet, the income statement, and the cash flow statement tell you how much the company owns, how much it earns, and where the money comes from. Not understanding financial statements is like a doctor who doesn't know how to read a lab report. He'll never truly understand the condition of the business. Start with the balance sheet to see whether the company has a strong financial foundation. Healthy businesses have plenty of cash and equivalents to handle unexpected crises. Their debt levels aren't too high. Long-term debt lower than 50% of shareholder equity is generally safer. Except for financial companies, accounts receivable should not grow faster than revenue. Otherwise, the company might be selling on credit and failing to collect cash. Inventory turnover should be fast. Walmart turns its inventory over 15 times a year, about 50% faster than competitors, which is why its capital efficiency is so strong. Next is the income statement, which shows how well the business earns money. You track the entire path from revenue to net profit. A higher gross margin means stronger product competitiveness. Matai, for example, maintains a 90% gross margin while its peers average around 60%. A lower selling expense ratio reflects stronger brand power. Coca-Cola spends only 15% on selling expenses, half of what smaller brands spend. Net profit must exclude one-off gains like selling assets. What really matters is the steady growth of profit from core operations. Finally, the cash flow statement tells you whether the money is real. It's the hardest of the three financial statements to manipulate. Operating cash flow must be greater than or equal to net profit. Apple's operating cash flow has long been 20% higher than its net income, proving its earnings are backed by real cash. Free cash flow should be positive and increasing year after year, showing the company can generate cash on its own without borrowing. The third tool is spotting financial fraud risks, the warning signs in the company's medical report. A great company doesn't just ingest money, it earns money cleanly. The author lists 6 warning signs that help you identify companies pretending to be better than they are. Warning 1. Cash flow and profit move in opposite directions. Net profit goes up while operating cash flow goes down. This can signal inflated revenue or bloated inventory, such as a home appliance company that ships excess inventory to distributors just to book sales, while products don't actually sell. Warning 2. Accounts receivable surge far faster than revenue, which often means the company loosened credit terms to pump up sales. This was common among internet companies in 2000. They booked huge revenues, but eventually could not collect the cash. Warning 3. Repeated one-time charges, such as restructuring costs or asset impairments. These may be used to hide long-term problems. One listed company made large impairment charges 3 years in a row, all to disguise poor operations. Warning 4. The sudden departure of a CFO or auditor. Insiders understand the true financial situation better than anyone. When they leave abruptly, they may be avoiding responsibility. Before the Enron scandal broke, its auditor David Duncan suddenly resigned. Warning 5. Inventory keeps piling up. If inventory grows faster than revenue, the product likely isn't selling. The company will later be forced to discount heavily. In 2000, semiconductor companies saw inventory explode and later had to cut prices by 50%. After identifying the truly good businesses, there's still one last step, deciding what price to pay. Even the best gold becomes a bad investment if you pay too much. In the next section, we'll talk about how to assess a company's intrinsic value, using discounted cash flow and the margin of safety, so you can know exactly what price is worth paying and avoid the trap of buying a great company at a terrible price. The core of valuing a stock is figuring out the gap between a company's intrinsic value and the market price. You only get a real opportunity when the price is far below the value. Pat Dorsey makes one thing clear in his book. This is not about perfect math. It's about being roughly right. You use multiple tools, cross-check your conclusions, and protect yourself with a margin of safety. First, clear up the biggest misconception. Don't trust any single metric. A lot of people think the P/E ratio is enough. But every single metric has blind spots. A tech stock with a P/E of 10 may look cheap, but if the company might lose money next year, that PP means nothing. Price to book works for banks because their assets are mostly cash, but it's useless for internet companies because their value comes from users, not physical assets. Price to sales only shows the scale of revenue. It doesn't tell you whether the business is profitable. A company can make $10 billion in revenue and still lose $1 billion. A high PS in that case is a warning sign. Dorsey says the right approach is to combine metrics, PA, PS, and free cash flow yield and judge them together with the company's moat and growth rate. Second, use ratios to find companies that are relatively cheap. PE is the most common metric, but you need the right version. Use trailing P real earnings from the past 12 months. Avoid forward P because analysts often overestimate future earnings. Then compare the current P with its own history. If the stock sits at 20 times earnings, and 70 to 80% of the past 10 years were between 15 and 25, then 20 is reasonable. But if the stock rarely traded above 18, then 20 is expensive. You also evaluate the P with growth. A fast-growing business deserves a higher multiple. If a company grows 15% a year, a P of 30 is fair. If it only grows 5%, 30 is too high. Now, price to book shows you the value of a company's assets. It works for banks, insurers, and heavy asset industries like manufacturing. But you must pair PB with ROE return on equity. High ROE plus low PB is the sweet spot. If a bank earns a 20% ROE and trades at 0.8 times book, it's profitable and cheap. But be careful with goodwill. A company may trade at half its book value, but goodwill may make up 80% of equity. In that case, the cheap valuation is an illusion. Free cash flow yield is the most grounded metric. Here's the formula. Free cash flow divided by enterprise value. Enterprise value equals market cap plus debt minus cash. The idea is simple. If you bought the entire company, how much cash would you collect every year? Think of it like rental yield on a property. Free cash flow is hard to fake and reflects real earning power better than net income. Third, learn to calculate intrinsic value and build in a margin of safety. At the end of the day, valuation means one thing. Estimate what the company will earn in the future. Convert it into today's money and add it up. Start by estimating the next 5 to 10 years of cash flow. Let's say the company earns $1 billion in real usable cash this year. If it grows 5% a year, then next year it earns $1.05 billion. The following year about 1.1, and so on. Next, calculate the discount rate. Money today is worth more than money tomorrow. If your bank gives you a 3% risk-free return, a stock must offer more. A super stable company like Mutai might use an 8 to 10% discount rate. A typical company uses 10 to 12%. A risky early-stage tech firm might need 15% or more. Then estimate the terminal value after year 10. You can't forecast forever, so use long-term economic growth, about 3%. If the company earns $20 billion in year 10 and grows at 3% after that, you plug it into the terminal value formula, year 10 cash flow, multiplied by 1.03, divided by the discount rate minus 3%. If your discount rate is 10%, that means divide by 7%. Then discount that number back to today. Finally, why do you need a margin of safety? Because your forecasts will never be perfect. If you think a business is worth 100, leave yourself a 30% cushion and wait until the price falls below 70. Even if your estimate is too optimistic and the real value is only 80, you still won't lose. For very stable companies like Procter & Gamble, a margin of 20 to 30% is fine. For typical companies, 30 to 40% is safer. For cyclical or risky businesses, you want 50% or more. In short, calculate what the company's future money is worth today, then deliberately discount it again. Give yourself room to be wrong. Here's the natural spoken English version, keeping the meaning fully intact but making it flow like a voiceover. To be honest, with thousands of stocks out there, trying to study every single one is simply impossible. That's why Pat Dorsey came up with a 10-minute quick screening method. It's basically a fast way to filter out the obvious disasters so you can save your time for the companies that actually have a chance. It's not meant to help you pinpoint the perfect winners. It's meant to keep you from wasting time and help you avoid 80% of the junk in just a few minutes. Minute 1 is about basic qualification. Start by checking whether the company has the most fundamental ability to feed itself. Look at the last 3 years of revenue. Is it growing year or shrinking? If it's shrinking, that's a downhill slide. And net income? At least 2 of the last 3 years should be positive. If it's losing money every year, the risk is too high unless you already know for sure it's about to turn around. Why does this matter? Because a company that can't even keep its revenue and profits stable is basically a toddler that hasn't learned to walk, let alone run. Don't expect high growth. For example, if a company's revenue has been cut in half over 3 years and it keeps losing money, no matter how good the story sounds, it's probably a trap. How to check it? Just open any finance site. Look at the financial summary, and eliminate anything that fails these basics. Minute 2 is about whether the profits are real, core profits. You want to know, is the company making money from its actual business, or is it living off one-time gains like selling a building or receiving government subsidies? What do you check? Look at operating income for the last 3 years, including investment gains or subsidies. It should be positive, and ideally, operating income should make up at least 80% of net income. Why? Because long-term success only happens when the core business makes money. If a company reports 100 million in net profit but shows a negative operating profit and only made money by selling an office building, that profit will likely disappear next year. Pass immediately. How to check it? Compare operating income to net income in the income statement. If the gap is huge, skip it. Minute 3 is about whether the profit is backed by real cash. Pretty numbers don't mean anything if no cash comes in. Check 2 things. Over the last 3 years, operating cash flow should exceed net income. Cash is harder to fake. If cash flow is consistently lower, the company might be selling products on credit or piling up inventory it can't sell. And cash flow shouldn't swing wildly. 10 billion last year and negative 5 billion this year is a big red flag. Why? Because earnings can be manipulated, but cash cannot. A classic example is Lucent Technologies. Earnings went up, cash flow collapsed, and eventually the company blew up. How to check it? Look at the cash flow statement. If operating cash flow is negative or extremely volatile, eliminate the stock. Minute 4 looks at efficiency and debt. You want to know how well the company uses shareholders' money and whether it's borrowing too much. The checklist is simple. The average row over the last 3 years should be at least 10%. The debt to assets ratio should be under 70%, unless it's a financial firm. And interest-bearing debt shouldn't exceed 50% of equity. If debt gets too high, interest alone can wipe out profits. For example, a real estate developer may have a 15% row, but an 85% debt ratio. If the housing market slows down, it's in trouble. How to check it? Look at the financial ratios. If they don't meet the standards, eliminate it. Minute 5 checks whether earnings growth is stable. You want steady, predictable growth, not a roller coaster. Check the last 5 years of net income growth. If the numbers jump all over the place, that's a bad sign. Steady 10 to 15% growth is far healthier than 1 year up 100% and the next year down 50%. Companies with huge volatility often live in extremely competitive or highly cyclical industries, like semiconductors. These are hard for ordinary investors to handle. Stable growers, like consumer companies, are much easier to judge. How to check it? Look at the earnings trend chart. If it looks like an ECG line, skip it. Minute 6 checks for hidden balance sheet problems. You want to know whether the company has a strong enough financial foundation or if it's hiding landmines. Check 3 things. Current assets should exceed current liabilities. Otherwise, the company might suddenly run out of cash and default. Accounts receivable shouldn't grow faster than revenue if they do. The company may be inflating sales by offering excessive credit. Inventory shouldn't grow faster than revenue. Otherwise, unsold products are piling up and may need to be dumped later. How to check it? Scan the balance sheet. If anything looks off, eliminate it. Minute 7 checks self-sustainability. Can the company generate its own cash, or does it rely on constant borrowing? Look at the last 3 years of free cash flow. At least 2 years should be positive. And free cash flow should be at least 50% of net profit. High profits, but no cash means fake prosperity. How to check it? Calculate it from the cash flow statement. If free cash flow is negative most years, it's out. Minute 8 checks whether profits rely on tricks. You want to know if the company is using one-off gains to cover bad operations. Look for the proportion of non-recurring gains in net income over the last 3 years. It shouldn't exceed 30%. If it does, the core business probably stinks. Also, avoid companies that keep reporting special charges, asset impairments, or restructuring costs every year. That often means management is hiding deeper problems. How to check it? Look at the non-recurring items section of the income statement. If it's too high, skip it. Minute 9 checks for shareholder dilution. Some companies love printing new shares, which shrinks everyone's slice of the pie. Look at the last 3 years of shares outstanding growth should stay under 5% a year. Anything faster means constant fundraising or excessive stock-based compensation. How to check it? Look at the share capital change records. High growth means elimination. Minute 10 is what to do after the screening. Once the bad ones are filtered out, take the remaining names and actually study them. Are they industry leaders? Do they have a moat? What about brand strength, cost structure, technology, and management quality? Are compensation plans reasonable? Do they buy back stock? Anything that failed earlier goes straight to your blacklist. Remember, this entire method is a process of elimination, not a way to pick winners. A company can pass all 9 checks and still be in a dying industry, like print newspapers, where the moat is disappearing. So, in the end, this 10-minute method is really here to save your time. The goal isn't to find the next superstar. It's to quickly throw out the obvious garbage. Like sifting sand, remove the big rocks first, then slowly examine the finer grains. Most retail investors can't study hundreds of companies. But with 10 minutes, you can eliminate 80% of the traps and focus your energy on the remaining 20. Passing the filter doesn't mean buy. It just means worth another look. Some stocks may pass all the tests but still be terrible buys because the valuation is too high, say. A PE ratio far above its historical range. In that case, it's still not a good opportunity. In the stock market, the people who truly make money are never the ones staring at candlestick charts all day or chasing every rumor they hear. They're the small group who can stay rational while everyone else is being driven by emotion. The real rules of the stock market repeats this again, and investing is fundamentally about going against human nature. When others are rushing toward hot trends, you're studying businesses. When others panic and sell at the bottom, you're calculating valuations. When others trade nonstop hoping to catch quick moves, you're quietly waiting for compounding to work. The key is having a system of thinking that isn't shaken by market noise. Rational investors typically do only 3 things. First, buying stocks means buying businesses, so you need to look past the price and understand the essence. Most people open their trading app and immediately check whether the price is up or down, while a rational investor asks, how does this company make money, and how much can it really make? In the short term, stock prices are a voting machine driven by emotion. In the long term, they're a weighing machine that measures real value. Buffett bought Coca-Cola not because the stock price was exciting, but because he understood its brand moat. People kept buying it even when prices rose year after year. Rational investors never take a pretty chart or an expert recommendation as a reason to buy. They check financial statements to see if the cash flow is real, calculate ROE to measure efficiency, look for moats to confirm competitive strength, and even during quick screening, they eliminate companies with chronic losses or long-term negative cash flow. It may seem slow, but it avoids most of the traps. Second, they rely on a margin of safety to control risk instead of gambling on luck. Many people like to say fortune favors the bold. But rational investors know that the real core of investing is avoiding big losses. Data tells the truth. Even the best company is a bad investment if you pay too high a price. In the 1990s, buying Coca-Cola at a PE of 50 meant underperforming the market for a decade. But during the 2008 financial crisis, buying great companies with strong moats at a 30% discount turned out to be extremely profitable. A margin of safety isn't about perfect calculations, it's about leaving room for error. If you estimate a company is worth 100, you wait until it drops to 70. Even if you misjudge a little, the loss is manageable. This conservative approach often lets rational investors sleep well through market crashes, while most people who chase highs end up panic selling at the bottom. Third, they hold for the long term and let compounding work instead of chasing fast money. Many investors dream of catching daily price spikes or trading wave after wave. but real-world data is brutal. Trading just a little more each year means fees, taxes, and costs that quietly eat your returns. And after 30 years, frequent traders may earn 60% less than long-term holders. Rational investors understand the math. A business that compounds at 15% a year will quadruple in 10 years and grow 16-fold in 20. That's not slow, it's steady. Companies like Southwest Airlines, which earn money for decades thanks to a cost advantage, rewarded long-term holders far more than those who traded in and out. Rational investors know short-term price swings are just noise, while consistent business profits are the real signal. Instead of guessing tomorrow's price, they let good companies rise naturally over time. The book says the biggest enemy in investing is impatience. Rational investors aren't naturally smarter. They simply understand that going slow often gets you there faster. The champions of the stock market are never sprinters. They're the long-distance runners who can stay the course. Ultimately, investing is the monetization of your understanding. The deeper your insight into a business and the stronger your control over your own human nature, the greater the rewards the market gives you. The real rules of the stock market doesn't tell you which stock to buy. It helps you build a mindset that prevents you from being exploited. A good company needs a moat, real earnings, and trustworthy management. A good price is one below intrinsic value with plenty of safety margin. A good strategy is long-term holding that lets compounding work for you. Once you use this logic to screen, price, and make decisions, you've already stepped into the rational minority. The market has always rewarded those who see the essence and have the patience to wait. This isn't motivational fluff. It's the conclusion repeated by countless real examples in the book. And congratulations, you've just finished another book that truly matters.